Hi there, I'm Matt Ishbia, President and CEO of UWM, and this is 3 points. First point, inflation and interest rate, the correlation. So understanding that the Fed rates do affect interest rates, but not as much as inflation. Inflation is what I'd be looking at to determine whether interest rates are going to go up or go down. Watch what inflation does. This consumer price index went up 0.4% on November 10th. That was less than they expected. What happened on November 10th? Rates went down significantly. Watch for the next time, December 13th, 8:30 a.m. Eastern. You'll find out the new CPI. If it's less than they expect, rates will go down. If it's more, rates will go up. That's a more tied-in indicator than the Fed rates. We know Fed generates at 0.5, 0.751%. We know what's going to happen with that. However, the Fed looks at it. Everyone looks at these numbers. So understand that inflation and our interest rates that we look for 30-year fixed mortgage rates have a lot more to do with each other than people recognize. I'd be looking for that December 13th date to see what's going to happen next. Second point, mortgage brokers hit highest market share since 2009. So the mortgage broker channel is growing. We've been talking about it for years. Loan officers are converting from retail to wholesale, becoming independent mortgage brokers. Also, we're seeing real estate agents and consumers are understanding that mortgage brokers are best. The broker share hit 22.25% in the third quarter. That's the highest it's been since 2009. That's a big, big deal. Brokers went down to 12, 13% for a while there, now up to 22.25% and growing. Retail is down a little bit, but the biggest thing is this. Brokers are the best option for consumers. Brokers are the best option for loan officers. Those two things are facts. The data supports it, and we're seeing the growth, and now the numbers are starting to show it. Third point, FHA Mutual Mortgage Insurance Fund, the MMI fund, as a lot of people talk about, is now at 11.11%. It's supposed to be around 2%. So seeing it's such a high ratio, it's natural that FHA should lower the mortgage insurance numbers, right? They are collecting money to make sure they have enough fund to take care of potential issues in the future. They have more than enough money. 11.11% is off the charts. Now, a lot of times they won't lower this, the monthly mortgage insurance, because they worry about refinances. All these borrowers are going to pay off, and all of a sudden they're going to lose a lot of the money. People aren't refinancing out of a 2.5%, 3% mortgage to go to 6.5% or 7% to save money on their mortgage insurance. So right now is the opportune time for FHA to lower their monthly mortgage insurance, help consumers, help affordability, help those first-time home buyers right now. I'm surprised they haven't done it yet. I actually think it will come soon, because even though they've said they're not going to at this point, we think it makes all the sense in the world to lower the premiums, help consumers, and at the same time, the MMI fund will be strong and secure for years to come. Thanks for joining me. I'm Matt Ishbia, President and CEO of UWM, and that was 3 points.